Calculating turnover for F&O is unique. It's not just your selling price. For options, it's the sum of your absolute profits and absolute losses on all settled trades, plus the premium received on selling options. For futures, it's the sum of positive and negative differences, absolute values. Don't forget any fair value of contract too, if applicable. Hey everyone, and welcome back to our channel. The world of futures and options can be exciting, but when it comes to taxation, it often feels like navigating a maze. With assessment year 2025 to 26, which covers financial year 2024 to 25, just around the corner, understanding the tax implications of your F&O trades is crucial. Why non-speculative? Because even though F&O involves derivatives, the income from their trading is not considered speculative under Section 43(5) of the Income Tax Act, provided certain conditions are met, which they usually are for regular traders. The first and most important step is correctly classifying your F&O income. For tax purposes, F&O income is generally treated as business income, specifically non-speculative business income. In this comprehensive guide, we'll break down everything you need to know about F&O taxation, from classifying income to filing your returns, making it crystal clear and stress-free. Let's dive in. Let's look at some key concepts crucial for every F&O trader. This means it's taxed differently from, say, intraday equity trading, which is speculative business income, or long-term/short-term capital gains from equity delivery. This is where being treated as business income is beneficial. You can deduct all legitimate expenses incurred solely for your trading activity. This includes, now let's talk about the dreaded tax audit. When is it mandatory for F&O traders? If your F&O turnover is less than rupees 2 crores, you might be eligible for presumptive taxation under Section 44 AD. Here you can declare 6% of your turnover as profit, provided you meet certain conditions. This simplifies compliance significantly as you don't need to maintain detailed books of account. However, opting for this for F&O also means foregoing the ability to claim individual expenses. So analyze if it's beneficial for you. A tax audit under Section 44 AB is mandatory in 2 main scenarios for F&O traders. Scenario 1. If your F&O turnover exceeds rupees 10 crores in the financial year, AY 25 to 26, provided at least 95% of your total receipts and payments are done digitally. Otherwise, the limit is rupees 2 crores. Scenario 2. If you declare your F&O income as business income and your net profit is less than 6% of your turnover and your total income exceeds the basic exemption limit, you will need an audit. If you can't fully set off your F&O losses in the current year, you can carry them forward for up to 8 assessment years. These carried forward losses can only be set off against future non-speculative business income. Regardless of whether an audit is required, maintaining meticulous records is paramount. Keep your contract notes, ledger statements, bank statements, and expense receipts organized. This will simplify your tax filing process and provide a strong defense in case of any scrutiny from the tax department. Once you've classified your income and calculated your figures, it's time to file your income tax return. Since F&O income is treated as business income, you'll generally need to file ITR3. This form is specifically for individuals and HUFS having income from profits or gains from business or profession. If you have other income sources like salary, house property, or capital gains, ITR3 accommodates all of these. Always maintain meticulous records of all trades, expenses, and supporting documents. Within ITR3, pay close attention to Schedule BP for computing your profits and gains from business or profession, Schedule P&L, your profit and loss statement for your trading activity, balance sheet, if you are subject to an audit, or if you opt out of presumptive taxation after opting in for 5 years. Schedule CYLA/BFLA for carrying forward or setting off losses. If your estimated tax liability for the year exceeds rupees 10,000, you are liable to pay advance tax in 4 quarterly installments. Missing these deadlines can attract interest under Section 234B and 234C. If you found this video helpful, please give it a thumbs up, share it with your fellow traders, and don't forget to subscribe for more valuable insights. If you have any questions, Drop them in the comments below, and we'll do our best to answer them. Happy trading and happy filing.